Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our study on IAS 20, Accounting for Government Grants and the Disclosure of Government Assistance. And this question that I'm going to solve with you is a very important question. It doesn't involve calculations. I told you that most of the questions in these standards are judgmental. It doesn't involve a lot of calculations, but you need to apply the basic principles of IAS 20 to be able to judge. So you are going to be given conditions and you are supposed to state how each of them should be treated in the financial statement. That's all. Okay, but it's a very serious exam type question that I want you all to pay attention to. And so without wasting much time, I want to read the question with you and then we'll solve it together. Just discuss and then we'll be done. Okay. Palmer Limited, a manufacturer and supplier of cashew products, has recently established a new facility in Damongo. To help in this new operation, Palmer Limited have secured a number of support from the government of Ghana and are unsure how the grants are to be accounted for in the financial statements. The company has a year end of 30th April 2021, and all the following transactions took place at 1st May 2020. So what we are going to do is that we are going to now give you each of the grants, and then all you need to do is to tell us how they should account for it and what type of grant it is. Thank you. So first one, a grant of 150,000 Ghana cedis paid to the company to allow it to settle its outstanding accounts payable and prevent it from going into liquidation. So that is the first grant that we are going to talk about. 2, a grant of 50% tax relief, the net effect of which is estimated at 85,000 Ghana cedis per annum, for establishing a manufacturing company in the area to provide employment for the youth. So that is the second one. 3, Palmer Limited receives a grant of 300,000 Ghana cedis towards the acquisition of a machine costing 500,000 Ghana cedis. The machine has a useful life of 5 years. Required. Explain again. Explain how each of the above should be accounted for in a financial statement of Palmer Limited for the year ended 30th April 2021 in accordance with IAS 20, Accounting for Government Grants and Disclosure of Government Assistance. All right, so this is a very simple question. All that we need to do is to go back, read again, and then we will analyze what it is. So you pick the first grant, you write on it. Second one, you write. Third one, you write, and you are done answering this question. So let's go back and then look at it again. Now, the first one, a grant of 150,000 paid to the company to allow it settle its outstanding accounts payable and prevent it from going into liquidation. How are you going to comment on this? Now, this one is a grant relating to income. So, we have grants relating to income and grants relating to assets, and each of them, you know how to treat that. When it comes to grants relating to income, there is just one way to treat it. So what you say is that, the purpose for which this grant relating to income was given to the company is that they should use it to settle accounts payable so that it will not go into liquidation. Now, these accounts payables came about because of purchases that has already been incurred. Okay, so what it means is that this whole amount of 150,000 Ghana cedis should be taken to the statement of profit or loss as income in the same year that the grant received. Now, the full amount of the grant should be taken. It should not be spread over any useful life because the expense has already been incurred. Therefore, we are going to use the whole of 150,000 to pay, and we are going to recognize the whole of the 150,000 as income in the current year statement of financial position. That is what you are supposed to write, and then you get your full mark for that. I told you this does not involve calculations. Now let's go and analyze the second one. A grant of 50% tax relief, the net effect of which is estimated at 85,000 Ghana cedis per annum for establishing a manufacturing company in the area to provide employment for the youth. Now, in Ghana, I don't know about other countries, but in Ghana, in our tax laws, there are some areas that are seen as deprived as far as the manufacturing sector is concerned, and the government provide tax reliefs for manufacturing companies that establish themselves in those zones that are neglected, and those tax reliefs are supposed to cushion the companies because they are creating employment in those places where the unemployment rate is high. That is exactly what Palmer Limited has received, a grant of 50% tax relief, and the net effect is that it's going to give them a cash back of 85,000 per annum. We are not interested in that. All these figures that are given are just to confuse you. Once you see a tax relief, it is a government assistance. Forget about the cashback figure that has been given to you in the question. Government assistance, because tax relief do not have any value. The 85,000 you see is just an estimate. There is no absolute value. There is no reliable measurement. We know that one of the conditions of recognizing the elements of financial statement is that it can be measured reliably. Here, there is no accurate measurement of the grants. It is just a percentage, which is going to give us a varying amount every year, depending on the level of profits that are made by the company. So what we are going to say is that anytime you see a grant that is in a form, it's not even a grant, or it's just an assistance, but they use the word grant to confuse you. Once you see any tax relief, 50%, 30%, whatever, what the examiner expects, or what you are supposed to say, is that this is just a government assistance. And look at the topic. What do we do to government assistance? We only disclose. So this one will be disclosed as part of the notes to the financial statement that we have received 50% government assistance as a tax relief for the location of establishment. And that is what you are going to write as your point 2, that the 50% will not be recognized in the financial statement. However, a disclosure will be made in the note that we have received a tax rebate of 50% from the government. That is how you're going to answer the second point. I'm sure you understand. And then we move to the last one. Palmer receives a grant of 300,000 Ghana cedis towards the acquisition of a machine costing 500,000 Ghana cedis. The machine has a useful life of 5 years. Now, this one is a grant relating to assets because it is given to purchase a non-current asset. Now, so the third point, the value of the grant received is 300,000, if I'm right. And then the value of the assets they are going to buy is 500,000. Now, you are not going to do any calculations, okay? What the examiner expects from you is that you tell us there are 2 alternative treatments for treating the grant relating to assets. It's either you net off the grant from the value of the asset or the cost of the asset, and you only depreciate the reduced amount. That is option 1. Or you open a deferred income account for the grant, and every year you transfer a portion to the profit or loss account so that it will offset the excess depreciation. So what the examiner expects from you is that you are going to, at the third option, third point, you write 2 options. That this is so you say this is a grant relating to income, and the standard permits 2 alternative treatments. 1, either we reduce the asset value by the value of the grant, and that's going to give us 200,000, and we are going to depreciate 200,000 over the 5-year useful life to give us a depreciation charge of 40,000 per annum. Or option 2, we are going to depreciate this 500,000 over the 5 years. That's going to give us 100,000 per annum, and then we are going to also credit a grant account with the deferred income, and then transfer a portion, and the portion is 300,000 over 5. That's going to give us 60,000. So we are going to transfer 60,000 every year into the profit or loss account so that the 60,000 will defray the excess depreciation. So when we net it off as the first option, we are getting a depreciation charge of 40,000. If we don't net it off, you are getting depreciation of 100,000 and the grant of deferred income of 60,000 to reduce that. And when you net this off, you are getting the same 40,000. So these are the 2 options. So you need to write for the examiner, but you may need to show some of these calculations in your third option so that your answers will be solid. So this is how you answer a question of this nature. Okay. I am sure this has really enlightened you further. Okay. Now, this will bring us to the end of a part 3 of our video on IAS 20. Remember to subscribe to the channel if it's your first time. Share this video. Let others also benefit. And until we meet again for another video, it's bye for now. Thank you.